This video is going to talk about Chapter 8, which deals with the stages of an audit, and the first stages, which deal with audit planning and setting materiality limits. So audit planning is required to follow generally accepted auditing standards, set forth by the AICPA, and they require that the auditors perform adequate planning to obtain sufficient and competent evidence, because again, they're going to judge this client or this company based on that evidence that they gather. However, you have to always weigh that with the cost, because to obtain the evidence is expensive. So the more evidence, the more cost. So you want to, again, be as efficient and effective as you can in the evidence that you gather. And then the adequate planning also helps to avoid any misunderstandings with the client. So the client understands what's going to happen in the audit, and the audit staff also knows what's going to happen, so everybody's on the same page. There's always risk. So most of this chapter talks about different levels of risk and materiality, but acceptable risk is how much the auditor is willing to accept that there might be material misstatements in the financial statements that they do not uncover with their audit work. The client business risk is that the client fails to achieve its objectives, so it's not successful, it's unable to pay its like credit loans that come due, or it's unable to compete in the market and it's going to go under. Risk of material misstatement is the effectiveness of the internal controls at detecting errors or fraud. So again, because the auditors don't ever test everything and there's no guarantee, they always are relying on the effectiveness of the internal control structure. So how much risk is in there? Like if they think, well, we have a lower level of acceptable risk, or if we have high levels of client business risk, or if we have, we don't trust their internal controls, so we have a high risk of material misstatement. Any of those things are going to say, okay, well, then we have to gather more evidence. But again, more evidence costs more money. So here's the stages, and really these stages are going to go through the next few chapters. So what's in green is what we cover in this chapter, which is the first 4 stages of the audit. So we'll talk about accepting the client and performing that initial planning, understanding the client's business and industry, performing preliminary analytical procedures, and then setting a preliminary judgment of the materiality, and then the performance materiality, which kind of takes it down to the account level. So that first step is accepting the client and performing that initial planning. So if it's a new client, we want to investigate their reputation and their financial statements. This SAS 84 requires that the prior auditors communicate with the new auditors. But that burden of initiation is on the new auditors. So the new auditors would have to reach out to the prior auditors. They'd also have to get the approval of the clients to get those records. But they really should do a thorough investigation to understand what type of a client they are taking on. Existing clients, again, you've already done all that initial work. Now you're looking at, do they have any lawsuits that are going on? Have they paid you for last year's services? If they haven't paid you, then obviously you're lacking independence, because you want them to pay you, and the audit firm is waiting on that. So again, you're kind of tied to them. And again, to identify, are they just being audited because they're publicly traded and they're part of the SEC? Are they being audited because they are getting a bank loan, or, kind of what is the purpose of that audit? Then the engagement letter is really truly the contract between the audit firm and the client. So it's very important to have everything outlined in that engagement letter. So again, there's a sample in the textbook. But you've got your date, you've got what the auditors are responsible for, what the management of the company is responsible for, and it discusses the fees and how they're going to write the written report. So kind of everything is outlined there. Again, it's almost like the contract between the two. And then they'll develop an audit strategy. So in order to develop that audit strategy, though, they have to understand the client's business and the industry that they operate in. So every business and industry is different. So many companies now, especially those being audited by your larger CPA firms, are global businesses. So they're doing businesses all over the world, or they have suppliers in other countries, customers in other countries. Again, with the computer and IT levels, there's far more connections where suppliers can actually log into the systems and place orders, or vice versa. The customers could log in and place orders, the suppliers can log in, check inventory levels, and so there's a lot of interfacing in today's computer world. So we also want to understand what strategies they have and their level of human resources, like who's in charge, what the chain of command is within that company. So performance, we're going to look at the industry standards, so in the external environment. So there could be special accounting issues within that industry. So say like with the oil and gas companies, there's definitely unique oil and gas accounting issues. There's we have to worry about our drilling costs, and what if we are vacating a well, how do we get it back to environmental standards? So those are unique things to that industry. So every industry kind of has some of those special accounting issues. The business operations, you want to go and actually tour their main facilities, identify if they are have any related companies that like are subsidiaries to them, or what related party transactions they have, so that you can really kind of understand the flow of the business. Management and governance, review their board minutes, their code of ethics, their corporate bylaws, their organizational chart, all that stuff, so you understand again how the information flows and how it's approved. And then measurement and performance. So look at what kind of incentives they are offering, or they're receiving in their industries, and kind of what some of those key performance indicators are to say, like, so for us at Stark State, like we have a dashboard that has those key performance indicators to say like student retention and how many students graduate, how long does it take them, different things that we know are important in our industry. So all businesses should kind of have some of those key performance indicators that the auditors can look over and see how they're doing. Then the next stage or step is our analytical procedures, performing preliminary analytical procedures. So a lot of those can be done by calculating ratios and comparing the company to the industry standards, maybe especially if it's a benchmark type industry standard, or they can also compare them to prior years to see, okay, how are they trending within themselves. So that can identify maybe some areas that, like, is inventory a problem? Do we think accounts receivable is a problem? So again, some of those big picture, or like our cost of goods sold, are those going up? Are they higher than everybody else in the industry? So you can kind of analyze some of those. You can also do like a common size income statement, where again you're comparing percentages of your sales to all of your expenses, maybe comparing those to the industry benchmark as well as to prior years to see how are they trending. Are they spending more on costs, more on advertising, more on labor, or less, or whatever. So again, it gives you kind of that bird's eye view of kind of what is going on. So we have to go through those steps at planning just to understand the business, understand where we think there could be areas of weakness. We'll do these analytical procedures again during testing to help reduce, again, the audit evidence that we have to complete. And then finally, in our completion stage, to kind of do that final once over to make sure, nothing looks, very, very off when we're looking at these numbers. And again, that's normally kind of done by a higher level partner or manager of the audit. So again, I kind of talked about some of these in the last slide, but I'll list them here again. So we compare the client to the industry, and a lot of times it's like a benchmark in the industry or a leader in the industry. So then we can kind of see how the client is comparing to its competitors. We compare the client to its prior years. Like I said, in those common size financial statements, we can express everything as a percent and compare it to the prior years to see how they're trending. Another big one that I hadn't mentioned yet was comparing their actual data to their planned data. So again, I mentioned, I think in the last chapter, that the oil and gas company I worked for was a big part of our annual process was to create a budget. And we would adjust the budget if major things happened during the year. So the budget was kind of a little bit of a breathing document. It wasn't like carved in stone. But we always compared our actual data to that budget to identify any material variances, anything that jumps out to say, well, hey, why is this not what we expected it to be? And then those variances require a little more investigation. Then we can go, if we were this company's audit the prior year, we have expectations of what we expect their upcoming year to be. So then we're going to compare their current results to what our expectations were. And again, any major variances would be flagged and then would be investigated. And then we could look at, again, non-financial data, so such as the number of units that we sold, or the number of customers that we have, or something that isn't actually dollars and cents, but could indicate an area that maybe we need to look into. Okay, then our step 4 deals with materiality. So materiality, we want to identify what would be material for the financial statements as a whole. So again, we're going to do that in our preliminary judgment phase, and normally in that preliminary judgment phase, it's based on our prior year data. So we may come into the audit and say, okay, wait, current year data is quite a bit different than prior year, so we may have to revise that materiality, but we always kind of start with our prior year as our preliminary basis. And materiality is not something that you could just always say, hey, everything over $10,000 is material, because it depends on the size of the company. So say you're auditing a smaller company, maybe everything over, $5,000 is material, or then you're auditing a very large company, maybe things aren't material until they're over 50,000. So you can never do that fixed dollar amount. You always have to look at it in relationship to, their net income, their assets, kind of their level, and then identify based on that what would be a materiality level that the auditors would be comfortable with. And really what that goes back to is to say, if there was a misstatement, say that's under $5,000, if that was my example, would that, and I didn't catch it because that $5,000 is my threshold, would that mislead a reasonable user of the financial statements? So if the answer is, well, yes, that $5,000 would, then you'd have to lower your level. So that's, again, kind of where those materialities are set. So there's also some qualitative factors, again, not the dollars and cents like income and assets and those kind of things. But if we uncover fraud, or if we've uncovered fraud in the past, that would obviously weigh heavier than just making mathematical mistakes or key punch errors in the system, because errors and mistakes do happen, but it's when they're intentional that the auditors would be a little more concerned about that. If it's something that violates their contractual obligations, because those kind of things, if you violate a contractual obligation, you could be subject to penalties, or like say it's a debt, that whole debt could come due and payable. So that could, again, be a very material transaction. So they need to make sure that all of those contractual obligations are accounted for and everything's in line. If it would change a trend line, so say if you're looking at your sales performance and sales have been going up 5% every year, then all of a sudden, because you made a mistake in your computations, sales drop 5%. But it's just a mistake that caused it. Obviously, that's going to be a big deal. Even if dollar amounts, it's not, just if it changes that trend line. And then we take it down to the lower level where it's performance materiality. So then what you're doing at that level is you're going through each category in the balance sheet to say, okay, let's look at our cash accounts. Let's look at our accounts receivables. Let's look at inventories, and then set different levels for each of those accounts. So it's not, again, the financial statements as a whole, it's more categories within those financial statements. So then here's a little step by step of how we evaluate the materiality. So our step 1 is setting the materiality for the financial statements as a whole. Step 2 is that performance materiality, which, like I said, is by category within the balance sheet, so in more detail. And that's all in our planning stage. Then in our later stage, once we actually start the audit, then we'll estimate a total of misstatement within that segment. We'll estimate how much the combined misstatement could be. And then we'll compare that combined estimate with our preliminary estimate that before we started the audit. So then to see, okay, are we on track, or we estimated that maybe there was a 5% error, and is that true, or then now is it 15%, something out of the ordinary. So again, how those things come into play, though, is what I have over to the right. So the auditor can uncover those misstatements during their testing. They could find them, but then those will be known misstatements. Then they're going to make some inferences from those. So they're going to say, well, okay, based on maybe difference in estimates of what the management's using versus the auditors, we estimate that there'll be more misstatements. Or we could say based on the number of misstatements that we found in our sample, so say 10% out of our sample, we had misstatements in those or errors, we can then apply that to our total population to say, okay, well, 10% of the whole population has errors, which would be a high percentage, and then they'd probably want to do more testings or maybe lower that materiality level. The sampling risk is to say, okay, because I took a sample, so say I randomly selected 100 items, what if that sample doesn't actually reflect the whole population? What if it is just a bad group of data? And then now I'm making some inferences and some judgments based on this data that really doesn't represent the whole population. So that's what a sampling risk is, but they'll have to deal with that because auditors do samples versus testing everything. So that is the first stages of our audit process. And again, the next couple chapters will pick up where we left off and continue on.